Before we get into the episode, a quick reminder that the last trade is for informational and entertainment purposes only, and nothing should be construed as investment or legal advice. Now for a word from Onramp. Onramp is a Bitcoin asset management platform built on multi-institution custody. We serve high net worth individuals, institutional investors, and financial intermediaries with a best-in-class suite of products, which include multi-institution custody, a spot Bitcoin fund, Onramp Wealth for RIAs, and private wealth services for high net worth individuals. Leveraging our partnership with BitGo and other industry leaders, Onramp's multi-institution custody is a first-of-its-kind institutional-grade vault, requiring 2 of 3 institutions at any point in time to sign once a client's unique permissions have been met. Our multi-institution vaults utilize cold storage, key signing, and authentication at the direction of the client to maximize security for client assets. This pioneering approach to custody is the foundation of Onramp's financial products, which reduce counterparty risk associated with trusting a single institution. To learn more about how Onramp can help you secure a new or existing Bitcoin position, please visit our website at onrampbitcoin.com, where you can schedule a consultation and connect directly with our team.
What you're telling me is that music is about to stop, and we're going to be left holding the biggest bag of odorous excrement ever assembled in the history of capitalism. 1974, 1987, 92, 97, 2000, and whatever we want to call this. It's all just the same thing over and over. We can't help ourselves.
I say when we sell. Hey, I say when we sell.
Woo-hoo-hoo-hoo! Welcome back to The Last Trade.
Is that the new intro, Marty?
I think so. Well, when we're pumping like we are, you gotta bring the energy week in and week out. Sitting at 37K right now, gentlemen. How we feeling?
Feeling good.
Good.
Really
Now I want to know what the price was when we launched the pod.
Look it up, Logan. Look that up for us, please.
I'm already starting to have that problem you have in the bull markets, where it's like the price is going up. I have almost all my net worth in Bitcoin, and so I should just be happy about it. But like, it also diminishes any additional Bitcoin that I can add to my stack, and that hurts a little bit. So like, already at mixed feelings.
Well, that means you just got to go out and make more money. It's actually a very good motivator to be productive throughout the economy.
You're not wrong.
You got to increase your revenue to keep the pace of sat stacking at a sufficient level.
Yeah, so we were roughly 26,000 in May when the pod launched.
Logan, I like that you're using StatMuse to look up the stat.
That's what came up for me too.
Did it?
Yeah.
There we
Came
go.
up for me too. When I looked it up, I went straight to StatMuse.
1031 portfolio company.
Eli, if you listen to this, we know you're out there somewhere.
You don't give a shield to StatMuse, 1031 portfolio company. Incredible sports data, but they're getting into finance data as well, starting with Bitcoin.
This is a little off topic, but there's Wemby Muse. Wemby, just a freak, San Antonio Spurs, going to see the game tonight. The Twitter Wemby Muse is amazing. If you just want to see like highlights of what's going to be like a generational athlete, what it's looking like, 7-4s, like dribbling up the court, shooting threes. Anyway, Wemby Muse, StatMuse.
We need to go to one of those games in Austin. Spurs are playing in Austin three times this year.
Yeah.
We got to get to one of those games. But we digress. This started because we're talking about the price. Obviously, we've seen a big price bump over the last month. I'm going to pull up the stats. Price of Bitcoin's up 40%, over $10,000, almost $11,000 over the last month. We'll start the conversation. It's going to be a broad discussion about Bitcoin's full potential valuation. But to start where we are today and to discuss this 40% increase in price over the last month, what is it? Many people think it's the ETF. What do you guys think? We're in this, was an 8-day period where the SEC has the ability to approve, do an omnibus approval of all the ETF applications out there. It seems like the price is moving in a way that would lead many to believe that they're going to get approved. Do you guys have any thoughts on this?
Yeah, Dylan, do you want to start there?
Sure. I mean, yeah, I think the ETF is a driving narrative, but it's interesting to me because, and this is a bit anecdotal, but also, just from like a volumes perspective and all that, like it seems like it's still the same pool, not like the same pool of incumbents. Obviously, there's outside capital that's increasingly looking at this. When Larry Fink comes out and is like, hey, it's it's an international asset. That's obviously a stamp of approval, but like none of the people that you'd think are, massive buyers of this spot ETF or Bitcoin as it's like kind of legitimized in the eyes of Wall Street or, the traditional financial institutions, like none of them have actually allocated at any size. It's just the supply of Bitcoin is actually more tightly held than ever. And it's super liquid, like spot volumes as of like a month ago, they've risen a bit, but we're all time lows or like lowest since 2018 and 2019 ish. And so, we're 50% from the highs, but, it's essentially just like the same group of people that have been beating the drum. And a lot of these outside institutions are looking at this and like watching it start to run. And, we feel FOMO as, Bitcoiners that are, talking about this on, 25 straight podcasts and every single day doing this full time. And like, we are fully allocated or like, or very, very much exposed. That's not true for like, a couple $1 trillion of capital out there that's looking at this thing saying, damn, I wish I had a 1% exposure. But like the crazy part is putting a couple $1 billion to work in this market, even at a $700 billion valuation is going to do a lot of damage to the upside, if you will. So this thing can really rip. The illiquidity is obviously a feature in a bear market. It's known as a bug, but that's pretty exciting in my view. So whether the ETF is approved in the next, 8 days or whatever, I think they're going to probably table it back. Maybe that's a cold take in a week from now. But yeah, I mean, I think the ETF is not like the driving feature. The driving feature is the fundamentals, which brought about the demand for the ETF, right? Like Larry Fink's not a Bitcoiner. He just has clients hammering on his desk to get an ETF across, right? So like, I think people are reversing the causality here. It's because Bitcoin's an institutional asset and legitimate in the first place that an ETF is now entering the conversation after all these years.
Hell yeah. I thought I was going to have the contrarian take by saying that, I'll believe the ETF when it happens. And until then, I'm not going to expect anything. And, it could very well be this week. It could be 3 months from now. It could be 6 months from now. I'm not going to allow myself to be surprised by any of them. But for me, the price action right now feels like summer 2019, which is a bit of a departure from. Yeah. So in, after the 2017 bull market, we got to 20,000. And then the price bounced off of 6,000 several times before breaking down at the end of 2018 and staying, in the 3,000 range for 3 months before starting to tick back upwards and had this crazy rally off the bottom going from 3,000 up to like 12,000 in Q2 2019. And so we blasted through the point of resistance, which would have been 6,000 at that point, because that had been the support in the bear market. And then we broke down under that. And in that first go, we managed to break through that $6,000 resistance. And there was so much excitement at that point in time. Marty and Matt were doing rooftop podcasts, encouraging everyone to stack at what ended up being the exact top of that rally.
Pico top.
And I feel like that's what's happening right now. And just in terms of the mechanics of this, I think this rally is actually just the market accepting that the bottom's in, and you better get on board if you haven't bought back in. And so that's, I think, fueling this rally right now. The difference versus 2019 was that obviously that rally happened a full year before the halving in May 2020. And right now, this is happening 5 months before the halving. So I don't think we have time for what happened last time, which in 2019, which was tailing off, and kind of slumping for 9 months before the excitement of the imminent halving really started to cause the market to pick up and find support at around 10,000 and then go up from there. So I think we just sort of shifted this rally from a year in advance of the halving to 5 months in advance of the halving. And that's going to mean, I think, that we don't have time to really test the lows again. And I think we'll find some sort of support. Anyway, I think that's actually what's happening. And that if that's the case, as Dylan is saying, that, this is really just the same old participants, that means that all of the yet to arrive participants, all of that is additional demand that has not come online yet and will add to the tailwinds that we're already starting to experience.
Yeah, there's a few things I want to add here because we did a live rabbit hole recap in Nashville last night, and this conversation came up, is this 2019 bull trap part 2? And it's very interesting. Maybe not even the 2019 bull trap that happened in the early parts of the summer, but if you look at the macro themes at the end of 2019, beginning of 2020, and then you line it up with what's going on now, it's not exactly the same, but fall of 2019, we had that repo spasm and a liquidity crisis in the repo markets, which leaked into the broader financial system. Then obviously we had the lockdowns in 2020, and then we had that Bitcoin get cut in half overnight in March of 2020. Then fast forward to fall 2023, and it seems like we mentioned the Treasury auction before we started to record, but the Treasury auction that happened yesterday was piss poor, worst demand for an auction in some time. Who knows whether the Chinese ransomware attack really affected that particular auction, but whatever. Seems like there's some stress in the banking sector, some liquidity problems that may be arising. And so I think that's an interesting sort of data point to take into consideration too. There's something similar happening, not exactly the same, this cycle in 2023 that was happening back in 2019, leading up to a halving. So who knows whether that provides some downward pressure on the price at some point in the future if people need to get dollar liquidity and therefore need to sell their Bitcoin. I'm not so sure that's going to happen. But then beyond that, one thing I want to clarify, going back to the ETF, and there's a lot of people out there saying that part of what's driving this 40% rise in the price over the last month is BlackRock buying Bitcoin in anticipation of ETF approval. And Jesse, I know you've gone through the filings, and Dylan, I know you've been covering the ETF stuff quite a bit as well. But does that mechanic, that doesn't make sense to me. You mentioned it, Jesse, BlackRock's customers are demanding this product. And the way I understand it, the only way BlackRock will buy Bitcoin is if people basically express that they have demand to buy shares in the ETF, and then they go out in the market and buy spot after that demand's expressed. Is that how this works mechanically? They can't buy Bitcoin.
Yeah, BlackRock's not buying
ETF.
Bitcoin.
Yeah.
BlackRock's not buying Bitcoin yet.
Yeah.
The mechanics of a vehicle like this are that when an investor wants to put dollars in, then that fund turns around, uses those dollars to purchase Bitcoin and grant units to that investor based on whatever the amount of Bitcoin is generated from converting those dollars into Bitcoin. And so that happens when the investor arrives and when the fund is active. There's probably some amount of you probably want to have you want to test it, I guess, and you want to, maybe BlackRock is trying to make sure that those mechanics work, but that would be just negligible volume.
It's like the meme. BlackRock's just poking the Bitcoin, just trying to make sure it works. They can purchase it and move it. The BlackRock this price action actually does feel like the ETF, and I could be wrong, or I'm probably wrong, but my thought is I anchor back to BlockFi and Celsius when they both crashed. They were already kind of priced in, like the market already knew. Remember when Celsius like dumped and there was announced, the price already fell, and then similar with BlockFi. It's like market participants already know certain things. It's just the nature of like the way these things work, especially smaller, such a nascent market. That's what I was thinking when the price is moving. It's like, oh, they already know. There's a certain like cohort. It's not somebody buying, like it's not BlackRock buying for the ETF. It's just people knowing, and that we do probably get it, in a relatively short order. And then the other part of the 19 is I was thinking about that, but then I was thinking about like that's a careful, delicate balance on like, thinking that, oh, it's going to run and then we're going to crash and then the halving. Because if it doesn't happen, it's like we all know to expect, like when things we expect them to happen, they don't. And other than exogenous effects of like global macro, if it doesn't happen, then there might not be that kind of like retrace that we saw in early 20. I guess it was 2019 and then 2020. There was like two.
Yeah. Yeah, it's just sort of trailed off for 9 months, going from 12,000 back down to 6,000 before finding support there. But yeah, we just don't have time for that kind of bleed out to occur with how little time there is before the halving. And the ETF excitement, to Michael's point, maybe it is real ETF stuff, but it's also quite possible that market participants realize that the narrative is enough, and they're participating in this narrative of the ETF is imminent, knowing that other people are going to be thinking that and acting on it, and it creates its own, bullish demand and narrative, even if it's not yet happening in reality. So that's also possible.
Fidelity writing every week about it doesn't hurt.
Yeah. Yeah, and the Bloomberg ETF experts that Dylan follows closely, I think their current expectation is 75% likelihood before the end of the year. I think
80.
Is it 80 now?
80.
So, they think it's real. We'll see.
I think there's a couple interesting points. One, and this is kind of to Marty's point, could just be like, coincidence or anecdotal, but if you think about the last time that Bitcoin topped, and also this kind of aligns with like in 2019, that echo bubble. And then also just if you look at the previous kind of the Fed tightening cycles, everybody likes to think like, oh, yield curve inverts or like this esoteric employment indicator. But, pretty simple is like once the Fed starts to cut, things get a bit ugly, like in the real economy, and that translates and bleeds into asset prices. Just look at the last time, like line it up, look at the S&P 500, look at the time the Fed cuts rates. And if you look, the Fed cut rates for the first time during that cycle in July 2019, right? So and again, there was like a whole bunch of exogenous factors. There was the plus token thing. There was all sorts of like BitMEX derivative shenanigans. Like this is obviously like there's a ton of entropy in this market. You can't just attribute it to one thing. And I do think that this time with like the expected BlackRock flows or, just institutions now viewing this thing because of BlackRock's stamp of approval in a different manner could definitely change the dynamic. And, that's being reflected in the price action. That's why, Bitcoin's up 30%, 40%, and, the S&P and NASDAQ are just, kind of flat over the last month. But I think it's just interesting to look at because, 2024, we have a few things lining up. We got the halving, obviously, probably the approval of these, investment vehicles, ETFs, and then also there's a good chance. And, a lot of the macro people, including myself, were banging the drum too early on this. But I don't think we've escaped the realities of like a tightening cycle and somewhat of an economic downturn. Whether it's like devastating or not is one thing, but we've kind of had this like artificial, steroided up economy for the last 15 years post Great Financial Crisis. COVID was like this, this kind of last burst of adrenaline to save a dying patient. And now we're a severely over-indebted economy still, and real rates are positive, right? Like not to, like I'm not trying to be a doomer, but like the math doesn't check out with real rates being positive with this much debt. So the longer that we're here, the more you're going to see this proliferate, which is happening, and the more you're going to see actual pain on the other side. And so I'm not saying this in terms of the Bitcoin exchange rate. I'm saying this in terms of like the global financial system, the global economy, right? The global sovereign debt levels, like the whole 9 yards. You know, we can obviously go down a whole rabbit hole talking about that. All this to say, on the other side of whatever comes of this tightening cycle, right? Whatever comes of the result of across the curve, 30 years to 3 months, real yields as indicated by inflation expectations, again, which take it at face value, they were hilariously wrong in 2020, they can be wrong again. And if they're wrong again, that means we get more inflation. All this to say that like real yields can't be positive or as positive as they are, 15-year highs, the highest they were since before the great financial crisis in 07, 08, with this much debt out there. So either we get a whole burst of inflation or they cut rates because things get ugly. And you're going to see probably at some point in 24 globally a fiscal and monetary cannon combined with the halving, combined with the ETF narrative all at once or, kind of in a row. Combine that with like bonkers price action and you get like an environment that's probably not as crazy in relative terms as COVID was, just because, the magnitude of that stimulus was unprecedented. Maybe you do, but I highly doubt that we get, an economy locked down and unemployment at 15% overnight again. But regardless, like we haven't experienced a real downturn. People don't know what a recession is globally, right? So that's something that, is a natural result of these cycles, right? You can't just escape reality or gravity for this long. Without facing consequences. And I think that comes, and the reaction function to that, whatever it looks like, whatever Fed Treasury, kind of like facility comes of this, whatever like this time's TARP or, bank term funding program or QE or yield curve control, like whatever it is, TLDR, like it's excess money in the system, right? Like that's just, boil it down to that. And so that sets up 2024 to just be like, in my opinion, just a crazy bonkers year. And, I don't know exactly how it plays out. No one does, of course, but it's going to be exciting.
Yeah. Yeah. It follows with the sort of theory that, every time you kick the can down the road, you have to put more effort into kicking it the next time. And the last round of stimulus for COVID was $10 trillion globally. And we obviously saw what that did to price of all assets. So if we have to, muster a greater kick in 2024 or beginning in 2024 in terms of stimulus, I don't know what we're talking about. Is it 10? Is it 15? Is it $20 trillion of stimulus that is needed to prop up the economy because we haven't allowed a proper recession since 2008 or really earlier than that? And that's also happening with Citadel yesterday. Ken Griffin is saying that he's expecting sustained high inflation this decade now. And so that's a shift from a prominent investor saying that, the part of that I think is the interest expense on national debt and how that is actually kind of stimulative to and expands the monetary base because suddenly you're having to spend more. As the government, you have to spend more in order to service your debt, and then that flows into the economy and helps create this sticky inflationary effect. All of these trends are lining up together. But Dylan, I wanted to ask, do you think that? It's kind of impossible to know, but do you think that if shit hits the fan in 2024, even to some extent? Do you think that negatively impacts Bitcoin, or does Bitcoin get recognized at this point as the solution or the lifeboat to all the sovereign debt problems? Martin Shkreli was tweeting yesterday about how Bitcoin's rally is because the U.S. is insolvent and people are waking up to that. Is that a narrative that helps Bitcoin become the lifeboat asset for fiscal crisis that it has always been and people haven't realized because they've assumed it's a risk-on tech asset?
Yeah, that's an interesting question. Anyone want to chime in?
Well, I was gonna say, I was gonna ask a question before we even jump. There's two parts. Like, I think I'd be interested in Dylan's response. But before going to that, I was thinking about, we have an ETF, right? Like an actual like financial product that's set to be launched. We have Fidelity talking about this stuff. Is what is going on in people's heads? Like, let's put ourselves in TradFi Bob, you know,
Hi, Bob.
TradFi Bob.
TradFi Bob. This is a nice archetype. I like this archetype.
Boomer Billy, Yuppie Sally. Like they've been hearing about Bitcoin for 6 years and 17, and now it won't go away. You have BlackRock stepping in, Fidelity. So like I was going to ask this, and I'm asking it, but before going to Dylan, and then also just like how are people even thinking about what the hell is happening? Like what is it? Because it's like, well, it wasn't real. It was rat poison, like all the things that we know and all the different like narratives, and now they have to start to think about it. And this is going to tie into obviously like full potential valuation and how they can start. But it's just like real questions, like what are our friends and family like? What the hell are they thinking right now?
What?
And it finally died in November 2022, right? It was like they were proven correct finally. It was like I knew it was a scam. It's like the Zihan thing, he's like at the Pico bottom, he comes on, it's like Bitcoin 16,000, like what do you think? And he's like, well, it has $17,000 lower to fall. It's like Pico bottom. It's like, this guy that's like generally respected on macro views and geopolitical, and he's like, maybe it's just an intelligence asset and is just saying that stuff because, but like he's like, no, yeah, and it's gonna, it's going to zero, it's going negative, and it just ripped in his face. And so, what do they think? Like, I think a lot of people don't know what to think because, it was an irrational exuberance in 2021, right? ARK, Tesla, just GameStop, Shiba Inu, Dogecoin. It was like, oh, it's just like that stupidness, VC, everything. And then they were proven right in 2022. It finally died. And now Larry Fink's going out there and saying like, no, this is an international asset. It's bounced up, flirting, back with $1 trillion again, like 800 billion. And, there's probably 12 months away from, $40 trillion in national debt. Like that's, yeah, it's powerful.
No, I mean, and not only have Larry Fink coming out, like putting support behind it, but you see this particular narrative, flight to safety. He said it. Muhammad Al-Arain said it. I think Paul Tudor Jones said it as well. Like, so the Bitcoin meme that's beginning to form at that layer of institutional capital is flight to safety, which is extremely bullish for Bitcoin. And then we were mentioning it before we hit record, but outside of this show, we talked to a lot of institutions about Bitcoin. And I'll just speak for myself. I've noticed over the last month or two, specifically, that the tenor has certainly shifted and people are definitely paying attention, asking more questions and seeking people out. Like, all right, I need to get smarter on this. Can you help me? I've experienced that with some pretty large institutional allocators over the last month or two.
Yeah, I think one of the things that's fascinating in all this is like one, just trying to put ourselves in the mind frame of like how we're thinking, because I think ultimately whether it's the institution or the individual that's your friend, they're pretty much on the same spectrum of the cohort that is like, this is all crap, or this is that, because it makes up the same people. So like an institution like Paul Tudor and the folks in those circles are the same kind of circles lower down the rung that are allocating, maybe it's less capital, and you still have this other group that's looking at it like, this thing didn't go away in 17, it's still here in 20, but what is it worth? Like, okay, can BlackRock custody it better than everybody else? So now I go, like, there's still this frame, they're trying to wrap like a position around it. Like, what is it? Is it physical? Is it digital? BlackRock's offering it up, so it can't be like completely vaporware, because I think that's where, or complete vaporware, that's where it had been like looked at for so long. And so it's just like an interesting thought experiment of like how like the mind is like wrapping itself around this like asset. And we're here, and it kind of ties into Jesse's question to Dylan of like, well, how are they going to think when the bonds and all these things go tits up? It's like they don't even know what to think about it today. Like with tits up, they're going to be thinking about there's all these other issues that are coming up around it. And it feels like there's a long way to go for it to get to that point where it's like this like the from an order of operations to be the actual savior or the thing that saved them.
Yeah. I in the Onramp roundups I've been writing weekly, and I said the same thing just recently in a conversation with Preston Pish. but there's like two extremely strong narrative violations that are happening that have already happened. Just recently, it's, for all of Bitcoin's history, it's been this, extremely volatile thing that you can't touch because it's far too risky. Massive drawdowns and stay away. It's toxic. And here we are. A year, almost directly a year after the second biggest exchange in the world collapsed, and Bitcoin is closer to its all-time high than the U.S. long bond, the U.S. Treasury bond. The second, narrative violation is like any person ever that's just bought Bitcoin daily from any date ever is in the green. You start on the all-time high. You buy Bitcoin every single day, starting at 69,000 in November 2021 to today. You're up 40%. So like the trope of like, it's far too risky, don't touch it, too volatile, stick with like the 60-40. Well, the 60-40 has gotten absolutely killed on no volatility. It's been killed in a straight line, no volatility downwards. While Bitcoin, obviously hyper volatile, has provided anybody that's ever just passively accumulated it crazy returns. And so like there's a shift there, right? Where like, for the longest time, it was just like the hardcore Bitcoiners, the crazy people that have laser eyes on Twitter that were saying this stuff. And now it's most definitely, and just from the conversations that we said we had prior to this episode, it's happening in boardrooms, right? Like it's not just this small corner of the internet anymore that's like saying screw you to the system and is like, anarchist money. It's like, oh shoot, like my return profile for my $100 billion fund actually is going to suffer if I don't understand this. And that's a different place than we've been ever, right?
MicroStrategy up $1 billion.
Yeah. I for me, my mental model always brings us back to like the bell curve of technology adopters, and Bitcoin is slowly making its way through the bell curve of who's going to adopt this technology. And for the first 15 years, it's been the absolute bleeding edge of people who have a reason to adopt this, whether it's because they're, anarcho-capitalists or just libertarian or technologists. And it has been slowly making its way and proving itself out too. That's an important part of this. It's the Lindy effect of it. It normalizes as it's around longer and longer, and it becomes more reliable because it's been around longer. And so we're still so early in the adoption curve, by any realistic assessment of like how far into the global adoption curve are we in terms of people who have adopted Bitcoin as a savings technology. We're still in the first 0.5% of adoption, which puts in the first 2.5% of the classical bell curve of adopters is the innovators category, which is to say that, after that is the early adopters. We're 1/5 of the way into the innovators category, let alone the early adopters category, then the early majority, late majority, and laggards. But I think that different types of adopters are on their own version of the adoption curve. Like it has to be the individuals who are bleeding edge and have a reason to adopt, who adopt first. And then institutions, their adoption curve doesn't start right away because it has to be proven out by individuals before any institution will consider it as a legitimate investment. And we're really just beginning that adoption curve now. The institutional adopters, so as we're collectively getting to this point in the adoption curve, new narratives start to matter for the incremental next slice of adopters versus what has happened over the first 15 years. And so I think the narratives for the next slice of adoption is more around like, how do I make sure I have a diversified portfolio and not miss out? Which is very different from what it's been for the last 15 years. And I think that's part of how like each successive slice of the adoption curve, when you're on the front half of it, becomes a larger and larger cohort of people who are adopting over the same space of time. And, in that sense, it's exponential. That's where the gradually then suddenly really plays out of we're reaching a exponentially larger slice of adopters just as this thing proves itself itself out and becomes necessary to incorporate into the average portfolio. And we're really just beginning that era, which is extremely exciting.
Climbing the S curve, gentlemen.
Yeah, and just like everything in Bitcoin, it's a lot more accelerated because there's asymmetry. And if you're not allocating like traditional tech adoption curve, like if you stay in the standard, maybe you're a laggard, but you're not like completely losing. Where if you stay in a bad form of money, you
Right.
may have no money, right?
Yeah.
And so
Yeah, and tying it back to the relative lack of liquidity that exists, like this pump has happened on relatively low volume. I think if you're comparing, this is actually a good segue into what we came here to talk about, which is Bitcoin's full potential valuation. But if you're comparing it to like tech adoption, like the Apple App Store or something like that, it's much easier. That adoption happens very quickly, but there's no like monetary value outside of Apple's stock price, which is somewhat elastic. They can issue new shares or buy them back. But with Bitcoin, it's finitely scarce with 21 million, and the reflexivity of the price as more and more people adopt this as we climb the S curve is going to be unlike anything we've ever experienced in human history.
Yeah, and I think one thing that ties into this full potential valuation is people generally that we know value, or maybe it's not people we know because we know a lot of crazy people, but people that are generally allocating to Bitcoin, they're holding 1%, 2%, 3%, and it's they have a personal account, they have cash, and they allocate. They're not thinking about it as like, what do I take out of my real estate portfolio? If they own 100 pieces of real estate in California, like that sounds crazy. And I think that's where like risk premium lies, and like most, I think people on this chat are holding the majority of their capital in Bitcoin because they've done the work and seen there's risk premium that exists across the spectrum of assets, and it's like all roads lead to Bitcoin and the liquidity profile, counterparty risk, and all the things we know about it. But I think that's really where that full potential valuation comes in, and looking at it, it's like, well, all of these other assets that people are holding that make up the majority of global wealth all have certain risk premiums, and they continue to increase as we know inflation's increasing. So I think that's like a big component. There's like asymmetry there that people are like measuring Bitcoin against maybe their dollar exposure, but not other assets and how they compare. And if you look at it long enough, you're like, oh shit, this actually competes with all these other assets. And again, the risk premium isn't like actually appreciated. And the easiest example is like San Francisco commercial real estate, right? But that goes down the spectrum of doesn't matter what the asset is.
I think also kind of adding to your guys' points about like the S curve and the adoption component, like I think there was, maybe it was like an early Bitcoin talk narrative, or just like how people perceived that this like hyper Bitcoinization trend would happen. It's like, I don't believe that, everybody is going to be on their iPhone denominating all things in Bitcoin, like in the Western world. That's unbelievable. And it's like, it was always a fundamental kind of misunderstanding of how the whole process would play out. It's like, no, there's going to be 1 billion people in the Western world that get exposure to this thing. A small kind of minority cohort will be doing it actively themselves, individually, personally, like through their, business, right? If they're an entrepreneur. But, the majority of people probably first are going to be probably not even knowing they own Bitcoin, because the pension, the 401k, the insurance, premium that they pay every month for their healthcare, right? Like, on the back end, they're buying the Bitcoin, right? They're like all of these fiat denominated liabilities that go out 30 years, right? Where the math just doesn't compute, right? Whether it's, on the government level, but more so like on an institutional level, right? Especially after all these fixed income portfolios took held to maturity, they're taking losses if they market to market of 30, 40, 50% on their bonds. None of the math makes sense. And so on the back end, like, Bitcoin as a hard money is obviously, like, as it's pumping and everyone is looking to it, that's going to play a big role. But so people what I'm trying to say here is like, people are going to own Bitcoin. And obviously we want as many people as possible to own it, self-custody, understand its full potential value. But a ton of people are going to get Bitcoin exposure because they own the S&P 500 index, or because their pension has it, and they have a small allocation that grows from 1% to 5%, right? Like, that's how a lot of people are going to get exposure to this asset. And just 10, maybe a handful of people, 100 people in the US are going to buy exposure in the coming years for millions, right? And like that's the thing that I think is a bit misunderstood in this whole transition.
That's a great point, that we are sort of shifting to, as institutional investors are waking up to this and the math on 30-year bonds, that those are become the decision makers and the trend setters. Like if you want to set a trend in the investment community, you influence Ray Dalio or Larry Fink, and those guys are waking up. Not so much Ray Dalio, only slightly for him, but and so Dylan's right that like it becomes 100 people making decisions on behalf of 100 million people in terms of how their pensions are allocated, or like what's the standard for corporate treasury incorporation of Bitcoin into corporate treasury reserves. That becomes how most people get backdoored into normalizing Bitcoin for their portfolios, even if they haven't personally adopted it as a savings technology.
Yeah, it's an extremely important point to internalize and understand. And that's it. Like, while we're on this conversation, I know we need to get to the full potential valuation, but the question in my mind is, how do you have somewhat of a controlled transition from bond exposure to Bitcoin exposure? Because you mentioned, obviously, a lot of these pensions, a lot of these institutions, these banks, if they were to mark their bonds to market, would be severely underwater. They understand that, and they understand they probably need the flight to safety that Bitcoin provides, but how do they do that mechanically without creating like a cascading sort of devolution of the market structure and treasuries that actually allows them to get a meaningful amount of Bitcoin? Like the slippage conversation, I guess.
The banks are all screwed for, and that screwed, put it lightly, right? Like Bank of America is mark to market insolvent. That's just like an incomprehensible idea a few years ago, or even, a decade ago, especially before the great financial crisis. And, all of this was just papered over with 10 years of QE and targeting on the long end and zero interest rates. And now, people are kind of waking up to that, like, the whole higher for longer narrative is like, maybe this fantasy, world like isn't true anymore. And I'm sitting here just like kind of laughing almost, because it's like, yeah, okay, higher for longer, but the debt levels are also higher than they've ever been. So it's like, we had 30% inflation over 2.5 years, 3 years, and debt as a relative percent of relative to productivity is higher than before the inflation shock, which is the opposite of how you're supposed to do it if you want to kind of like manage this transition and get back to somewhere where like you're not past this supposed like event horizon. So for the banks, like who knows like what the Basel requirements are, and like that's kind of a whole boring world. But increasingly, like, and maybe this is like, I don't know, maybe this is like going to be flat out wrong. I'm not saying like super cycle up only. There's going to be plenty of volatility, but I think there's a potential for this thing to happen quicker than most people can comprehend, right? Like rip faces, like the 10, 15 year thing of like, oh yeah, we're going to kind of just like 2x draw down, kind of, bubble up, collapse, and we're going to do this for another 15 years. Possibly, in my view, might be a naive view on things. As you said earlier, like the reflexivity of this asset and idea and the technology behind it is compounding, and most people just looking at it on a linear chart don't understand what's unfolding. And so that's where it could happen like faster than even the most bullish people believe. And not to be like a moon boy, but you know what I mean? Like this could really, really get crazy.
Dylan, it's a Friday morning. I could use some moon boy juice, so thank you.
Well, but I think there's legs to that simply because of this anchor point that the math doesn't add up. When people start waking up and there's bags of zeros, banks are insolvent. It's probably not the states, because we'll come up with some BTFP or whatever. But there's going to be other places that are having zeros, and that's when stuff goes no bid, because people are looking for an asset with a profile that they can take and they can put wherever they need to put it, or they can verify that it's theirs and it's sitting somewhere. that's the, like, I think gradually and suddenly moment is everybody starts to coalesce. And we've seen mimetic world in the past, couple of years, let alone 10 years. Once it's the thing and everybody wants it. It doesn't matter like if it's a new app, new meme, whatever it is. And so that's where, like, I think what Dylan's driving to is like all the math doesn't add up. And when somebody goes to the bank one day or something real happens and you can't get that. And that's why I go back to like counterparty risk. And we talk about these like Sprott, and there's a couple of the, it's not ETFs. They're quasi ETFs, like the trusts that deliver commodities. And everybody's always like, those are really small footprints compared to like GLD. And they're like, well, they think of it as like they were either wrong or nobody really wants it. It's like nobody really wants it because they didn't know that they wanted the delivery of it because it was always there when they asked for it or they could get the dollars. But I think we're going to a world where people stop making whole on their obligations. And that's effectively when this thing gets crazy.
Yeah, and that whole process, I think, is kind of the starting point for full potential valuation analysis of like when people do the math and realize that these other asset classes cannot deliver reliable returns in real terms.
Do we lose Jesse?
Everyone.
Jesse, we're losing you. It's not the worst. It's not the worst.
Wi-Fi.
It's not the worst pause phase I've ever seen on this show, but it's not the best either.
Maybe Logan, we throw up one of the slides on the full potential, and then he'll come back and see it, and he'll be ready to. The one that I'm thinking of is the chart with the different asset classes, but maybe there's a different one.
It's the rectangle chart.
Yeah.
I can hop in here for a second and maybe provide some color until Jesse gets back. And this is kind of in relation to the full potential valuation idea. But when we say like the numbers don't add up or like, the math doesn't compute, Jesse's back. Maybe I just let him rip on it.
No, you keep going. You keep going. You got kicked out. You're going now.
All right. Well, yeah, I'll just share this one, I guess, stat or idea. But like we're in very rare air in terms of the debt levels globally, but like in the U.S., right, we're the world reserve currency. There's only been 53 instances ever of nations with this high of a debt burden, and all of them have defaulted except the U.S. today and modern day Japan. And so people oftentimes you'll have these kind of debates, like these long-term macro debates, and they'll say, yeah, well, Japan got away with it, right? Like, look at what they're doing. And I just sit there and laugh because it's like, yeah, look at what they're doing. They're doing yield curve control and the yen's collapsing against every other currency that matters. So it's like, if your base case scenario is like, oh, don't worry about it. The U.S. can escape this, and not just the U.S., like the U.S. as kind of a reference point, and like the dollar as every other currency is a derivative of the U.S. dollar essentially. And all the debt is a derivative of the U.S. sovereign debt market. Like, oh, okay, the analog's Japan. So we're just going to conduct yield curve control, screw the creditors, screw the savers, and the currency is going to utterly, collapse essentially. Because like, look at the price action of the yen, right? They just, okay, yep, the yield passed 25 basis points, or they moved it to 50, and they moved it to 100 basis points on the 10-year. And whether it's explicit or implicit yield curve control or some form of like BTFP facility that, maybe is a bit more broadened, and is definitely some word salad that like most people don't really understand what's happening, right? Like there's not wide scale outrage because who besides maybe like 10,000 people understand the mechanics of the bank term funding program, right? Like it's just this esoteric thing, but what is it? It's like bailing out Wall Street and the banks instead of Main Street, right? So like you have to do this at a wide scale level because again, the math doesn't work. So if you're thinking the Bank of Japan and then the Japan analog is what we're facing, what's the other side of the equation for the dollar, right? Like what's the dollar just devaluing at a rapid pace on? Is it gold, right? Is it Bitcoin? Like these are the questions that have to be asked, and like shockingly few people are asking them. They're like, oh, higher for longer, and I'm just sitting there like, what are you even talking about? Because like none of the math makes any sense.
Yeah. And to that point too, like I'm looking for a chart now. I can't find. I think Lynn Alden was tweeting it out a week or two ago. But if people use like Japan's yield curve control example and be like, look, they did it, they were fine. They're making a critical mistake where if you look at like the median and mean average income, or the median and mean income in Japan, they're much closer. Like they have a much their wealth gap is much less wide in Japan compared to the U.S. And so like just like the literal income landscape across the two countries is completely different, and that's a cultural thing that is different between Japan and the U.S. And so like that they've had relative stability in Japan because of the lack of the wealth gap that exists there compared to the U.S., where if you were try to say that the U.S. can do what Japan did for the last 3 decades, it's simply not going to materialize just because of the makeup of the wealth gap in the United States compared to Japan. Culturally, they decided to batten down the hatches and have everybody live somewhat equally from an income perspective.
Interesting. I wasn't familiar with that. That makes a lot of sense. Sorry, I got cut off. I could see you guys talking, but I was frozen.
Thanks for tuning in to The Last Trade. If you're enjoying the show and want to dive deeper, check us out at onrampbitcoin.com, where you'll find a full suite of institutional-grade research and analytics, including our recently published white paper, Bitcoin's Full Potential Valuation, and our new tool, the Onramp Terminal. Now, back to the show.
Anyway, so to pick up where we were leaving off of, like, this is the segue into what we're here to talk about, the Bitcoin's full potential valuation, and this is the path of connecting the dots that points to this analysis of, if we're entering this several decade period where at all times every investor has a menu of options for how they can allocate their capital. There's different types of assets they could be sitting in, and you care about diversification, but most importantly, you care about performance in real terms. And if we're entering this era of debasement, bonds in particular will suffer because those are future promises for dollars. And if you're debasing the dollars that they're paying out, that hurts the value in real terms of that bond contract. Similarly, hurts for fiat money if you're holding that. But it also impacts every other asset too. It impacts equities because if we're in an era of stagflation, for example, we had that in the 70s. Stocks went sideways for a decade. They were down in real terms, sideways in nominal terms, down in real terms, because the economy was struggling. And it's harder to deliver strong performance when people are consuming less because they're struggling to pay their bills. And you're also having to devalue future cash flows in your valuation model. You're discounting them more because you're pricing in higher interest rates as that stagflation becomes stickier and you expect it to last for longer. So anyway, the equities start to underperform in real terms. And so what performs well? In the 70s, it was gold, which had a 14x over the course of 12 years. And that's hard assets. Hard assets do very well in a period of high inflation, and Bitcoin is a hard asset. Gold is a hard asset as well. And so, when I first got into Bitcoin, when I arrived at Bitcoin only in 2020, a big part of how I was thinking about, what's the opportunity here is trying to figure out what can this thing become. If this thesis of, the changing world order, the breakdown of sovereign debt, the reset of sovereign debt as we know it, if that plays out, what does it mean for Bitcoin in terms of its full potential? And that's a management consulting exercise that you often run to try to understand the potential scale of an opportunity. Usually in management consulting context with regard to like a particular business unit or product line for a company. But in this case, what's the full potential for Bitcoin? What can it become in the global asset landscape? And so that was the exercise that I sort of was kicking around in my own head and doing scratch math on in 2020 and 2021. And I've crystallized it into a full report for Onramp here in 2023, which, by the way, for everyone, is available to download on Onramp's website. So if you go to onrampbitcoin.com, and right there at the top of the page, there's a button that says download the Bitcoin's full potential valuation report, available to anyone. So you could just click that button and see this whole report. And so Logan's just pulled up on screen the first page here of this report, and the general arc of it is taking stock of, first, what is a full potential valuation exercise, and then what are the necessary ingredients that you have to have in place in order to complete that exercise. And the big ones are you need to understand what's the total addressable market, and that is an exercise of understanding how much value is out there. So you need to have a size for the total global asset value landscape. And so that's step one. And then the exercise becomes, what's the ceiling for Bitcoin in this landscape? And that is an exercise of taking stock of the strengths of the other assets versus Bitcoin, and figuring out, in particular, relative to these other specific assets, what could Bitcoin take? And bonds is the best example, because we were talking earlier about how for everyone holding bonds in their portfolio, maybe it's 40% of their portfolio in the classic 60-40 portfolio, and this math isn't adding up going forward. And people may go through their own personal exercises on an individual basis of reassessing what their portfolio allocation currently is, and decide, what, maybe I don't want to have 40% in bonds. Maybe I want to have a piece of that sitting in hard assets. Maybe that's gold, maybe that's Bitcoin, maybe it's both. And as this math plays out, it may become clearer and clearer that Bitcoin is performing better than bonds and will perform better than bonds. And so that percent allocation may grow as people become more confident in that math and people allocate appropriately. So, and that's an exercise that has to happen for every single asset bucket in the global asset landscape in order for you to come up with your own personal expectation about what's possible if Bitcoin siphons away X percent of value from this asset, Y percent from this other asset, and so on down the list. And you sum up all of that, the amount that Bitcoin has captured from these different store value buckets, to figure out what's the potential, what's the full potential for Bitcoin's valuation. And then what does that mean in terms of the price per coin? So that's the arc of this analysis. And Logan, if you want to pull up the global asset landscape chart, we can talk through that, because a big part of this analysis was trying to take stock of how much value is out there. And I was sort of surprised that nobody really had a clear answer on how much value is there in the investment landscape. And so I kind of put to work the management consulting toolkit that I got from my time at Bain to triangulate from various data sources how much value sits in real estate, in equities, in bonds, in the other smaller categories like precious metals, art, collectibles, and then of course there's money itself, how much is there. And through that exercise, I came up with this number of there's $900 trillion of global asset value out there, of which Bitcoin is, well, at the time, just a month ago, is 500 billion. Now it's a little bit more, but we'll say it's 500 billion. And so that's about 1/2000th of the world's value, which is pretty shocking, because that means it's 0.05% of the world's value is sitting in Bitcoin. which is quite a small percentage. And so that's your starting point for this analysis. And then we get into, what sets a ceiling for these different asset categories in terms of how much value they can store, and how Bitcoin is different because it doesn't have the same problem that all of these other asset buckets have, which is that there's new supply being added to any store of value bucket. Gold being a classic example, where there's 1.5 to 2% more gold being added from gold mining to the above ground supply every single year. And that's been true for the last century. And so the ceiling for gold in terms of how much value it can possibly store is really based on how much value the market can absorb per year from new supply coming online. So 2% of gold is a $12 trillion asset category, asset class. There's $12 trillion of gold in the world. And so 2% of that every year, gosh, my math is going to be a little fuzzy on that. What's it, 240 billion, I believe, in supply, new supply that has to be absorbed by the market every single year. And that sets the demand side of that coming, into contact with supply sets your equilibrium in terms of the price, spot price of gold for gold coming into the market, and that dictates the price, the total value that's stored in all the existing gold reserves in the world. So it's really the intersection of supply and demand, and supply being that key ingredient here. For all of these categories, it sets the ceiling for what's possible in terms of how much value can be stored in gold, but also in art, in real estate as well. And Bitcoin has this crazy property of increasing scarcity, which is to say decreasing issuance over time with every 4 years with the halving of the block reward. The block subsidy. And that means that over time, Bitcoin's ceiling isn't based on supply. It's based on something else. There eventually is no new supply. So it doesn't have the same ceiling that gold has, the same mechanics for a ceiling that gold has. In that sense, it has an unbounded ceiling. And then what becomes relevant is not how much supply the market can absorb every year, but rather how much you want to hold Bitcoin versus other assets in your portfolio. And then from that comes this final exercise of taking stock of the individual categories here, and then it becomes a personal choice, choose your own adventure exercise of going through and thinking, okay, what feels right in terms of what Bitcoin as a superior store of value asset with these more attractive properties, especially in the context of the end days of fiat money and the debasement that has to follow. How much of each of these categories will Bitcoin attract away from these categories in terms of capital?
This is so bearish.
Yeah. And so I came up with my numbers of what percent from each category, and I kept them conservative. That was, at least in my mind, conservative. And then you sum them all up in terms of how much value flows away from these categories and into Bitcoin. Sum up all that value, divide by 21 million, and you end up with $10 million per Bitcoin. And so that for me is the, I think, conservative full potential valuation for Bitcoin. And so I know that I didn't intend for it to turn into a monologue of the entire analysis the whole way through. But if that was interesting to anybody, if that sounded crazy to you, and you want to test the rigor of that or see these numbers, and especially if you want to take a look at this methodology and input your own assumptions, go check out this report available at the onrampbitcoin.com website, right there at the top of the page, and get your copy and see if it makes sense to you, or update the numbers based on what you think it should be, and then compare that end result against the price of Bitcoin today and see if you're not bullish.
Yeah, I think there's probably a lot of thoughts. The one thing I want to call out is I really love the I forget the title of the graph. Is it the asset valuation or the global asset landscape?
Yep.
I think if for anything, going to look at that one if you're listening and haven't seen it, because I think like it's like a cousin in my mind of the stock to flow model. It gives somebody like a mental model of how to look at the asset, and then also question what are the other assets and why are they worth that way, and then like thinking about the properties against Bitcoin. So yeah, I think that it's a good framework to look at, and I think a lot of times people think about, again, going back to TradFi Sally or whatever her name was, she's just looking at this thing like, what the hell is it? It's just an orange coin, and it keeps disappearing in people's wallets or whatever, and to like start thinking about it as whatever it is, and then against other assets, I think is helpful.
Yeah, you confirmed what Hal Finney said in 2009.
Yeah,
you
he
actually went and like found he had like the rough estimate, but you went and like found the hard details.
I think you stole it. I think you stole it from Hal, probably, but
yeah. Yeah, I think that's right. Yeah, he had a very different methodology, but he comes up with a similar number. His assumptions there actually is that there's X amount of value in the world, and that Bitcoin will consume it all, which is not the assumption that I take here. But he's starting with sort of wrong inputs. Okay, Logan pulled it up.
Heard from Jesse, Hal was wrong.
As an amusing thought, for those who can't see it, but this is what Hal said in 2009, like right when Bitcoin launched. As an amusing thought experiment, imagine that Bitcoin is successful and becomes the dominant payment system in use throughout the world. Then the total value of the currency should be equal to the total value of all the wealth in the world. Current estimates of total worldwide household wealth that I've found range from 100 trillion to 300 trillion, with 20 million coins, which is wrong, it's 21 million. That gives each coin a value of about $10 million.
Yeah. So obviously Hal was just kind of doing a rough assessment here. He didn't spend several days gathering data points on each of these asset value buckets and then triangulating and adding them up. I think that the main difference, the assumption that I will say Hal gets wrong here, it's kind of rare to be able to claim that Hal's wrong about anything. I think what Hal gets wrong is that the assumption that all of the value flows into Bitcoin, because today there's $120 trillion of fiat money, and yet there's $900 trillion of global asset value, which is to say there's only 120 trillion. Let's say it's all dollars. There's only 120 trillion greenbacks, and yet we price all of these other assets. We value them in dollar terms, and so that means that there's actually 900 trillion greenbacks worth of value, even though a small percentage of it is actual money. And Bitcoin will end up in the same sort of position, assuming it takes over the world of money. We will still have other assets, and they will still have value. Real estate will still be valuable. Monet paintings will still be valuable, and certainly equities will still have value. They may all be priced in Bitcoin terms and expressed in Bitcoin terms, and yet there's only 21 million Bitcoin. So we started this before I said I have a bit of a hot take that I think ultimately the world ends up with 100 million Bitcoin worth of value. And, obviously there's only 21 million Bitcoin, but it's because we express the value stored in all these other buckets in Bitcoin terms, even if that value isn't currently held in Bitcoin at that point in time. And so I think that's the departure versus what Hal was doing, where he assumed that Bitcoin becomes 100% of all the value. Whereas this analysis assumes it ends up being 20, maybe 25%. And that's based on my conservative assumptions. It could end up being 50%. Maybe it ends up only being 5 or 10% for some unforeseen reason. But that's the sort of the challenge to everyone listening of like, go take a look at this analysis, see if it's reasonable to you, and then change it based on what you think is even more reasonable. And I think that's the power of going through this report.
Yeah. So let's do this right now in the roundtable. We'll start with Dylan. Logan, pull up the chart where the last chart. No, that one you just had up. And Dylan, I think this is very bearish, particularly looking at the Bitcoin capture section of this. And this is conservative. I am being a bit facetious here, but I do think we could get some valuable discussion out of everybody's perspective of how much Bitcoin actually captures in these different asset buckets. So we'll start with Dylan. What do you think of this conservative breakdown put forth by Jesse? Too conservative? Too optimistic?
I think it's a good starting point. I've kind of had a similar.
You can say it, Dylan. You can say it's too bearish.
It's bearish.
Well, I mean,
very bearish.
Honestly, like I think it's it gets the point across of at a $700 billion valuation currently. With all these things that we covered beforehand, it's just laughably mispriced. And then and the entropy of the world and just Bitcoin kind of monetizing around the world and kind of programming us all to work for it and slave away for it every day. That'll do the rest. So I don't know. I don't really have. I think it's a great way to ballpark it.
I actually have a good framework for Jesse's point on like why art, because it's always the Mona Lisa. But Mona Lisa, if we go through this framework, like we can all probably agree Bitcoin's a better form and would probably consume all bonds, because you're basically going to like price a bond in Bitcoin terms, like what Bitcoin you get back. Real estate, the question with real estate would be outside of the utility of owning 1 to X number of homes that you would need from like, vacation. It takes all the investable value out of it, because we know all the attributes of Bitcoin mirror real estate, but just in digital form. Gold over time. So you start looking through the list and you're like, well, what would you price a premium over the monetary premium? And the couple that you go to is like, well, fine art. But then a lot of people are holding fine art because of, there's this like natural thing that happens, whether it's real estate or whatever is in a portfolio that somebody gets rid of because they rather hold Bitcoin as they learn about it. And I think that actually happens with fine art as well, because it's like, even if it's like, why am I paying the insurance cost and all the like overhead, because it's still not free to put the Mona Lisa somewhere. And then equities obviously are just a derivative of Bitcoin. Like the money will flow from an equity that's worth, dog shit. Basically, somebody holding WeWork would rather sell it to go into BTC, and then you start to reprice equities, and then you get dividends from the, exposure to it. So anyway, going through this, I think you end up like, I think Hal is pretty much spot on the margins. You have some like things that people like because they look at them and they're pretty, but they don't consume a monetary premium, which most of these things have done because of inflation, even if it's gold inflationary rate. Yeah.
I'm looking at real estate particularly, and like, I think this is 1 or 2x off at least. You can bring it back to the quad box. So you have like 15%,
45% from real estate.
Yeah, because you think about it, like New York City is a great example of this. You get all the high end real estate in Midtown by Central Park, and it's literally just foreign wealth parking their wealth outside of the confines of their own country, using it as a savings vehicle. They never live in the apartments, in the penthouses. They just buy it to store wealth in Manhattan real estate over time. Like, getting back to what Michael said, like real estate has a utility, which has a cost that's worth paying for. And then you have the premium on top of that utility, which is typically dependent on aesthetics and location. And so like how big is the value of the utility, and then how much is the overall premium on the aesthetics and the location on top of that? I find it hard to believe that's 85% of the total real estate market right now.
Yeah. Quite possibly. I'm actually fully on board with what you guys are saying, and so I think that my conservative assumptions here are overly conservative. I think that's like, when you do an exercise like this, what you are trying to defend against in terms of what inputs you're picking is you want people to not attack those assumptions. You want people to like actually engage with the analysis. And that's a big part of why you pick the conservative assumptions, because, taking 15% from real estate is plausible to anyone who thinks about it. Taking half, some people might reject that and then not engage with the analysis. But yeah, you're right. Like, who's to say it doesn't take 50% of real estate? And I think bonds is the even bigger case here of, if we're repricing the world in Bitcoin and shifting away from this, exponential growth monetary based fiat system, then the bond bucket shrinks tremendously, and it all becomes expressed in Bitcoin terms. But it could shrink to be 1/10 the size, and then you're talking about all of that value, 90% of that value flowing into other things, Bitcoin being the winner, because Bitcoin replaces bonds in terms of its function in a portfolio, where bonds today are what they promise to investors is a small guaranteed yield, even if it may or may not be real yield and versus just nominal yield. And then what Bitcoin does is, because of its increasing scarcity and the fact that it's a finite supply, and that it can then reflect growth in GDP, is then passed down into the expansion of value of Bitcoin over time, because it has that finite supply. Then Bitcoin becomes a guaranteed yield. It's just a totally different way of thinking about it. You're not getting more Bitcoin, but because of increasing scarcity and the finite amount of it, it's guaranteed to appreciate in value if you get there in terms of accepting the logic there.
It yields you more goods and services throughout the economy, essentially.
Yeah.
Purchasing power. Yeah.
And then that ends up replacing bonds. It does what bonds were able to do over the last 40 years, Bitcoin can do going forward indefinitely. And what bonds were able to do over the last 40 years, bonds will not be able to do going forward. Fiat bonds, because of they have to be debased in real terms. And so that, like, you could end up taking 90% of that bucket instead of the 30% that I assumed.
One of the things that's most interesting is what does the cost of capital turn into, like for a bond, for somebody to lock up, like a Bitcoin bond, or we talk about equities and it's going to be repriced, but it's like somebody's going to have to pay a dividend on that, because you're not just going to lock up your capital when you can just hold it because of the purchasing power and the risk premium on the equity and the execution of the business. That's the most fascinating thing, because now you start thinking about everything in a different version of it, which is like some of us already thinking about that world and that. It's like, well, do I want to,
Yeah. And that's where the last trade comes in, right? Because until we reach this end state, like, there's no point in holding anything else if Bitcoin's going to vastly outperform everything, just as it monetizes, as it bootstraps from no value to its end state value. And only in that end state does it then make sense to do what Preston Pysh talks about, of like value investing on a Bitcoin standard in equities.
Yeah. Well, there's been a nuance there too. I agree. Like, everything held static if we were in a vacuum and we were able to adopt Bitcoin quickly. You should hold it till it fully monetizes and then go do that value investing. But in the meantime, companies do need to be formed. Products and services do need to be brought to market. So you're like weighing the opportunity cost within that transition is. And
they're especially valuable if they're generating Bitcoin. Like, if that business is operating on a Bitcoin standard and generating Bitcoin, then it is insulated against that.
And that's the other beauty of like Bitcoin, is everybody always talks about, like, whether it's an investment in Bitcoin or using their Bitcoin, or what we just referenced and we got caught in it. It's like, it's always assumed the end state is $20 million Bitcoin, I hold it, it's there. But the reality is life happens in between then. And that's where like everybody has their time preference and what they need. And that's what money's utility is for. So it's always constantly changing. That it's very rare, somebody holds from X to Y at the end state of it. It's like you have all these things happening in the middle and it's always discounted. It's always like, oh, this is the opportunity cost. When you get too far down the rabbit hole, it's like the reality is we probably never see that, or like we see it, but the capital is being spent because you have like, that's what it's used for. It's not meant to just be sitting there like dormant.
This last 5 minutes conversation is just so alien to everybody and everybody that's invested in the last 40, like, or really anyone alive. It's like
Wouldn't go well
the
on
concept
CNBC.
of like
He goes, anybody alive,
it's
not
like,
even anybody invested, just anybody on the planet Earth right now. Just
no, anybody alive that's sitting here listening to this and it's like, you can save money and gain purchasing power and do what? Like, where's the passive investing into the S&P 500 come in? Like, where is that? And it's like, we live in this world where the money debase is in perpetuity. The last 10 years, the cost of capital has been negative. So the best bet, the winning bet has literally to plow into a basket of the 500 biggest companies at any price every day, regardless of what they do, regardless of what the economic conditions look like, and you print money. And it's like going from that world to a world where the money doesn't lose value. I mean, it's obviously hyper volatile now, but delivers, positive, compounding positive returns over meaningfully longer time frames. But in a world where like it's the unit of account, it's the denominator, and you can just save money, not lose your shirt due to inflation. And then if you are so inclined, if you are, if you have an edge, if you think there's an opportunity to put capital to work, you conduct economic calculation, you invest capital into equity or a debt instrument with an expected return, and you make that calculation. It's not just like, okay, going to plow money into bonds and hope the Fed buys them. It's like, okay, I'm just going to plow money into the S&P 500 and they're going to borrow at a negative cost of capital and buy back their stock. Like, we live in this world that's so disconnected from reality. And so, going back to the transition component, like, who knows exactly what it looks like. But I think even after like this whole thing monetizes, like after this plays out, there's still people that are going to be really confused on the other side of like, okay, but now what? And it's like, what do you mean now what? Like, we live in a world where like we could, like, the game still goes on, right? Like, there's still businesses, right? You can still do stuff. Like,
You just got to do good, productive stuff because the opportunity cost of losing somebody's Bitcoin is very high.
Dylan, I think on the other side of that, they'll have learned along the way. I think what we're seeing is a great example is the middle is the Gemini Genesis 3% yield is the problem, is that people are still thinking in that framework. And that's why we always like anchor in what we're building here is like, it's easy to buy the Bitcoin. It's hard to hold it long term. And everybody's just trying to rug you along the way, whether it's education, get into this cryptocurrency, get into this ETF. And Gemini was a great example. What is it? A bit close to $1 billion. That's just like evaporated because they had their, whatever account, custody account, and then they sent emails. It's like, you want your 3% yield to financial advisors or individuals. And they're like, oh yes, I need to generate passive income on this thing versus sitting on it. And so I think the ruggings along the way get on the other side of that as it appreciates. It's like, oh yeah, this is like, hopefully, at least in a wishful thinking, that on the other side of that, people realize you don't have to go chase risk.
Yeah, I mean, obviously, it's hard to predict exactly how everybody's going to come to that realization, but it's
the hard way.
The hard way, yes. But Parker put out a piece last night about like how people are going to begin accepting Bitcoin as payment for their businesses. And I think the way he lays it out in that piece is exactly how it's going to happen, how people are going to come to the realization that the mindset from which you operate when you're investing in businesses or going to build a company, each individual comes to that decision or that realization individually at their own pace, and then collectively in mass. It just happens at some point in the future where the realization is just hit a critical mass where that's the way things happen. And just one man at a time. And it's very rational line of thinking is essentially what Parker said. It's like, if we've all come to the rational decision that Bitcoin is good money because there's only ever going to be 21 million, it's distributed, so it can't be corrupted. And that is extremely logical, and particularly to us and rational to us. Like, it's just going to take time before the rest of the world comes to that rationality as well.
I have a simpler format than that. And like I've shared it with you, and a lot of people will talk about like circular economy and all that. I think it's just once somebody's cost basis appreciates, and we're just so low. Like i.e. I buy it at 10K and now it's 30, and now I have some, there's a gap there and I can spend the Bitcoin, or it's, bought in. Most people are relatively gotten out of underwater or pretty flat, so they wouldn't spend it. And then the price goes to 60, 75, 80, 100K, hits a certain threshold. People have the delta between their cost basis, and then they go and use it as a form of money, and not a moment before then.
Yeah. And what's happening to create that delta? It's more people coming to that rational decision and using Bitcoin.
Not using it, buying. I mean, using, I guess, by the form of holding.
Yeah.
Using it as
but holding is using.
Yeah, holding's using, but they're not like out spending Bitcoin, and that's causing it to cause the price appreciating. Like, people are buying it. They're buying it as a, they're not buying it because they think it's going to go to 20 trillion or 20 million per coin. They're buying it because Larry Fink said it's Daddy BlackRock said to buy it.
Daddy BlackRock. You've got a lot of good nicknames this show.
We got to come up with a name for these boomers that are coming in.
Hey, we're not an ageist podcast. We love our boomers. A lot of boomer listeners out there. We love you guys, okay?
What do you think about what do you think about the boomer BlackRock ETH ETF?
Should we talk? I mean,
I cannot wait to read the legal language in that filing. My God. I don't think the funny thing is the crypto people were celebrating it all yesterday. And the first thing that I just laughed at was, when you read the Bitcoin filing and there was all these things and that make no sense, they just have to put it because worst case scenario, it's like in the case of a fork, like we have the discretion to choose which side. And they say all this stuff that's like kind of nonsensical. And you're like, hacking the Bitcoin network? Like, why would you even put that? But when you think through like proof of stake, social slashing, like a 51% attack on all this stuff, you're like, and this is, going back to, this is a whole rabbit hole, but like the stablecoin issuers and the critical mass of the DeFi apps and all this stuff. And in the case of a fork, right, or like a protocol level change, they can basically hold the entire network hostage by saying, hey, you lose DeFi, you lose literally all of your applications if Tether and Circle leave, right? So if you're super bullish ETH because they're going to buy like X amount of the network, well, you obviously haven't thought of like their quite literal stakeholder decision-making value on top of that. Mm-hmm. And that's like, that's just the difference in architecture from proof of stake and, quote unquote, like the consensus layer, which is like the social layer for ETH versus, the Bitcoin network. So that's my 2 cents. I thought it was pretty funny.
Any ETH bull that is championing this is completely idiotic. I mean, they don't even have to amass 50%. I think they have to amass something like 33% to have essentially full control over the consensus of the network. And if you don't think BlackRock's going to be applying some KYC, AML, travel rule compliance at the protocol level when the governments of the world tell them to, like, you're completely
ETH and BlackRock, they're like literally a match made in heaven. You can even see like maybe BTC ETH like in terms, like kind of ETH is there for a while until like BlackRock does whatever BlackRock does, and then you're kind of like, oh, I don't own any ETH anymore. That's not my ETH. Or like they change consensus or whatever they do, and you're like looking around and like, oh wait.
Yeah.
People are bullish. It's already there. It's like Coinbase, Kraken, Binance, like, and Lido, which is again like the governance token is controlled entirely by US VCs. Like it's already there. It's already captured on it, like at a protocol level. Like Brian Armstrong, scroll through his retweets. They're talking about KYC implementation natively on the network in wallets, like not abstracted to the exchange level, but like, and they're I forget, they called it some buzzword. So it's just like, if you can't see where all this is going, with more coins funneled into centralized hands. And again, like there's a fundamental change between the network consensus mechanisms where holding, Michael Saylor holding 150,000 Bitcoin doesn't give him any more say over the network than anybody else. He's running a node, anybody running an economic node gets their say. right? So it's just a misunderstanding of how things work. If you are championing, ETH proof of stake funneling into the hands of, 3 or 4 institutions.
Yeah, I'm looking for the Matt Odell thread going back to like 2017, where this is it's all very tiresome. But Bitcoiners have been calling this out for, here we go. This is from, December 2017. Pull this up, Logan, but this is all very predictable. Like when you're dealing with proof of stake chains, the consensus mechanism, like he who has the coins controls the consensus. And so Bitcoiners have been warning about this for the better part of a decade now. And it's all very predictable. And again, I think it's important to bring it up now because it's likely going to this next bull cycle. Bitcoin's not going to be the only cryptocurrency to pump. All these shit coins will pump as well, and the noise is going to increase significantly. There's going to be a lot of cheerleaders out there saying, look, ETH, Solana, they're all better than Bitcoin. They're appreciating in value. Like, Bitcoin's the boomer coin. You need to get in on this stuff. But at a fundamental level, just talking about how these networks actually work, if they're to be successful and actually be valuable in the long run, they need to be sufficiently distributed, and any proof of stake chain has no shot in hell of doing it. Like, this is all very predictable. As soon as the exchanges can stake your coin, they're going to accumulate a mass majority of them collectively, just simply because of the economies of scale that they can provide the market and provide better yield. And people, at the end of the day, are not going to care about decentralization. They're going to care about the yield they're providing. And the exchanges can inherently just provide them more yield due to, again, their economies of scale.
Yeah.
This is the Brian Armstrong. One last point, going back to kind of along with what Marty's point is. It's a quote retweet. It says, compliance innovation coming on chain. And he's quote retweeting someone at Coinbase saying, tokenization requires all applications have a KYC attestation process. The KYC process today is archaic, like the system it was built on. But this is changing. KYC, digital ID, attestation status, it's all coming to the wallet. Compliance innovation is what it's called. Yeah, I mean, writing's on the wall here, guys, but, I digress.
Yeah, that's one way to offer unlicensed securities is make sure you're capturing KYC AML when you're doing it. That's going to be ugly. We'll see what carnage happens in the next cycle and beyond. Marty, you said one word that I'm realizing it brought up memories of when I was getting into Bitcoin, and the word is shit coins. And I think that I probably dismissed the Bitcoin community as a serious group for slightly longer than I otherwise would have, because Bitcoiners were constantly saying shit coins and like just offhand dismissing these other projects, which, now I totally get, I totally agree with. But I feel like it slightly does us a disservice. Not to like,
don't browbeat me on air.
I'm just like pontificating about like thinking about how, like, what would have helped me get into Bitcoin sooner. And I think it all stems from like coming from a yuppie background, and like people don't speak disparagingly of their competitors in the non-crypto world. And I feel like it's like a funny thing that I don't know what the answer is to it. Like, is it just to just ram it down everybody's throats and until Bitcoin has proven that all these other coins are shit coins, or do we try to meet people in the middle? I don't know. That's just sort of.
I get what you're saying. I agree to a certain extent. And I, for the longest time, even myself, it was rare for me to say shitcoin. Still is to this day. I just, in haste, said it because I was trying to think of it.
And I say it too, because it's true.
I usually say altcoins. Because
I try to as well.
Altcoins was the predominant nomenclature up until like 2013, 2014. And then shitcoins took over.
Well, since we're kind of airing out our grievances with how we're going to our nomenclature, the one that I probably shock everybody is like I kind of feel like we have to figure out a new way to reference ourselves and not be Bitcoiners.
Because
like,
it's
it feels very culty. It's like we're just like we're just guys. We're you don't want to. It's like the Bitcoiners. It's like there's gonna be this chasm we got to cross where
it's
we
even
can
like it's even things like orange pilling. They had an Oster event in Nashville, and it was a great event, and everybody there, incredible people, but I was like cringing throughout because many people were like, "Yeah, I orange pilled this person, then I purple pilled this person." I was like, "This is not like how we're gonna get
you don't
this
want to be handing
out
out pills to well-heeled professional investors. People don't want that.
Yeah. See, we'll have a strategy call. We'll come up with there's terms that we'll for the pill there'll be a term, for the individual that is recognizing a better form of money there'll be a term, and we'll help incept in the market.
Yeah, I just got lost in my own thinking of I was appreciating how effective that is for conveying to individuals, like shit coins and orange pilling. Like those are very effective, like micro metaphors. Just it conveys all the rich imagery that you need to know in a single word. But when thinking about the adoption curve for institutions or the mainstream in general, like our nomenclature is going to have to evolve in some way.
It's hard though because they're all dog shit, but you just
yeah. I mean, just
I don't know. I have no answers. And
I hate another one I hate. I never refer to myself as a Bitcoin maxi. When I do, I'm like, some people would refer to me as a Bitcoin maxi. I hate that term. Started by Vitalik, by the way.
I embrace that one. Why do you hate that one?
Oh, that one I will never utter. That one's the worst.
Interesting. Yeah. I embrace it. I'm a Bitcoin maximalist. Like so Vitalik tried to put that on us, right? As like a slur. And I think it is I don't know. I like it because I think I want to maximize my Bitcoin exposure because
then it gets like they call you a maxi. It's just like I'm just a dude who likes Bitcoin and wants sound money and freedom in the world. Like,
I'm a Bitcoin supremacist.
Yeah. There is no second best.
Yeah. There's your subtitle for this episode right there, Logan.
A white Bitcoin supremacist.
Oh boy.
I know we joke about this stuff, but I do think it is important because I think to Jesse's core point, it like hindered his full adoption or like and there's these things that you hear and you're like, I don't want to be a Bitcoiner. Like I'm just a dude. Like I don't want to be
know? That's the way I am. Like even when people call me Bitcoin, I'm like, I'm just a dude who likes sound money. And I think Bitcoin's the best sound money.
Yeah.
I want freedom.
Yeah.
I've always hated labels when people like try to call me right wing, left wing, liberal, conservative. I'm like, stop. I'm a dude with my own thoughts. I like Bitcoin.
Yeah. It's tough because at the end of the day, what we like is money that retains its value. So like, what's the term for that?
Rational human being.
Right.
Bitcoin rationalist.
Yeah.
Sorry, Marty, that was a total tangent. I didn't mean to go there, but I just was lost in thought of like,
Jesse, you have nothing to apologize for. I actually think that was a productive little tangent there because it is important. Language is important.
Thank you.
Was it?
I was just thinking. Yeah.
Well, maybe I'll take the lull to say that again, if people are interested in the full potential valuation piece, I think a big part of why we put this together is so that for Bitcoiners or for rationalists out there who understand the value of Bitcoin in their portfolio in particular and want to have something to give to the people in their life, friends, family, colleagues, to help make the scale of what this thing is relevant, salient, understandable. This is a great piece of collateral to be able to hand off to folks. So check it out, at least for that. Also, if people are enjoying Dylan's analysis, and I always do, he writes every week for the Onramp weekly roundup, putting out all of his market analysis thoughts for that week. And if you want to get that in your inbox as the download of what you should be paying attention to this week, because you're not necessarily, I would happen. Did I freeze again?
Yeah, you froze again.
It was in the middle of the plug.
Yeah, well, go check out the on the Onramp website. Go to Research and Insights. Sign up. Get your name on the mailing list for Dylan's weekly roundup. And we also put out a piece every weekend that's just general Bitcoin education.
Or Truth from the Commoner. This doesn't benefit Onramp, but Marty's new website, awesome thumbnails. I was chatting with Jesse yesterday. I was like, I don't know how you're doing it or if you're purposely pulling it, but it had the nice Dylan's piece this past week on the thumbnail, had the nice Onramp terminal chart.
Yeah.
Very good for social sharing that.
I like to think it does help on exposure. It's
Oh, it does. But I just meant like go sign up for Truth for the Commoner. There's a lot of good information coming.
tftc.io. Yeah, become a member of all sites. We're going to win, gentlemen. And bringing it back to the valuation framework, the webinar you guys have coming up, and using this as an asset to pass along, I think it's extremely valuable because historically, still to this day, people see the price of Bitcoin, see it go up to 65,000, fall down to 15,000, and they just see these numbers on a chart that are extremely volatile throughout the first 15 years of Bitcoin's existence. Or like, what is this thing worth? Why is it going up like this? Is it just some price chart that goes crazy and the numbers get higher and then fall lower? Like, why is it doing that? Like, to have a framework from which to explain, like, this is why this is happening. Here's the potential addressable market of this asset and why you're seeing these volatile spikes and crashes in price over the first 15 years, because it's people trying to appropriately price this asset in real time. The first time humanity's priced a monetary asset in the digital age globally at the same time. And that's driving the volatility. You may see these price movements on a chart and think, what the hell, it's not worth anything. I think this piece does a really good job of laying out the landscape of the potential addressable market of Bitcoin and why the price is moving this way towards.
Yeah. So if you're a rationalist, if you're a rationalist out there and have other rationalists you want to understand Bitcoin over Thanksgiving, I think the date is December 1st that the webinar will occur with Jesse and our head of strategy and research, Brian Kubelis, and then a special guest, TBD, on when that'll be announced. Yeah, special guest. Could be you, Marty. Could be you. You
don't want me on that call. Yeah. I'll be like, this is too bearish, 10 mil. It's going to be 100 at least. What was I going to say? I had something else to say. Gentlemen, I don't want to like pick the Pico top here and cause a big price dump, but this could be like the best Thanksgiving we've had in a few years, you know?
Yeah, true.
We're gonna be the kings at the table.
Yep. Maybe that's the last point. Are we at 40K by Thanksgiving?
Oof.
37,252 right now.
I'll say yes.
I just have disbelief, like, and I'm glad that I'm not on the sidelines like I was in 2019 when I thought I was going to be clever and buy lower, because then I was forced to buy in like when this was happening. And for anyone out there who's in that same position, it feels a lot better when you finally get back in. So that's my 2 cents. I fall for the disbelief even now of like, I simultaneously believe that we're going to $10 million per Bitcoin in the next couple decades in today's dollars. And yet I have trouble believing we'll be at 40,000 at Thanksgiving.
Very pragmatic. Very.
Well, you never know. Who knows? We'll see. I mean, we've got, I think, 6 more days to figure out if that omnibus approval of the ETFs comes out. If that happens, we could be at like 50K by Thanksgiving. I think we could have like another 10K candle, weekly candle.
one thing's for sure, it'll be Bitcoin rationalists will have a much better time at Thanksgiving dinner than they've had the last 2 years.
Yeah. All the father-in-laws looking at the rationalists being like, who did my wife marry? They're going to be like, yeah. This year you're going to be like, she married a good one. Don't worry, sir. I'm going to take care of your daughter. Okay. Dylan, do you have anything you want to wrap up with?
No, I mean, yeah, I do the weekly letter with these guys. Good cadence. I mean, it was a fun rip. Don't really have too much else to add. Don't have any short-term price predictions. Have learned to kind of over the years to kind of just, it's kind of irrelevant. So, hell of a rip. Appreciate you having me on as always.
It's good. Let's find a background with less gold next time. Okay.
We'll work on it.
I kid. Gentlemen, it's a pleasure as always. Dylan, most tenured guest on this show. Almost becoming the fourth host.
Mitch is going to want to come back on. Yeah. He hit me up the last time after his third episode. He's like, am I the tied with Dylan for the most? Like,
not anymore. Mitch, you got to get a good mic too, if you're listening. Let's go. Go forth. Be rational. Enjoy your weekend. That's all we got today.